The history of global finance is often written in moments of silence, the quiet signing of a treaty, the subtle adjustment of an interest rate, or the stillness of a bank vault. But every once in a while, history is written with a roar. We are standing on the precipice of one of those moments. Right now, in the opening weeks of 2026, the second largest economy on Earth is undergoing a seismic shift. It is a movement of capital so large that it is difficult for the human mind to truly comprehend. We are talking about $7 trillion. That is not a typo. That is not a projection for the next decade. That is roughly 50 trillion yuan, a wall of cash that has been locked away in silence, now preparing to flood the gates. To put that number into perspective, $7 trillion is larger than the entire GDP of Japan. It is larger than the GDP of Germany. It is a sum of money that, if mobilized, can alter the trajectory of global markets, rewrite the price of commodities, and fundamentally change the balance of financial power between East and West. For the last 3 years, the narrative surrounding China has been one of caution. We heard about the property crisis. We heard about the struggles of the real estate giants. We heard about a population that was frightened, holding on to their cash, refusing to spend, refusing to invest. They were hoarding money in fixed-term bank deposits, seeking safety above all else. But as of January 2026, the safety lock has broken. According to new data analyzed by Bloomberg, a massive wave of these fixed-term deposits is maturing. The time is up. The contracts are ending. And the Chinese people, from the billionaire industrialists in Shenzhen to the retired civil servants in Hangzhou, are looking at their bank statements and realizing a hard truth. The bank is no longer the place to be. Today, we are going to explore the great rotation of 2026. We will look at why this money is moving, where it is going, and why it has triggered a historic surge in the price of gold and silver. We will look at how the Chinese state itself is quietly cornering the precious metals market, and what happens when a $7 trillion tidal wave crashes into the stock market. This is the story of the money that woke up. To understand the magnitude of what is happening right now, we have to look backward. We have to understand the psychology of the Chinese saver. For decades, the primary vehicle for wealth in China was real estate. You bought an apartment, then you bought a second one, and maybe a third. It was seen as the only asset that never went down. But when the property crisis hit earlier in the 2020s, that belief was shattered. Prices stagnated. Developers faltered. The average family in China looked at their crumbling property values and decided that risk was the enemy. They fled to the safety of the banks. They locked their yuan into time deposits, essentially certificates of deposit with terms of 3 to 5 years. They accepted that they wouldn't get rich, but at least their money would be there. This created the mountain of cash we see today. A 50 trillion yuan stockpile. But markets are cyclical, and safety comes at a price. While that money was sitting in the dark, the economic landscape outside the bank vault changed completely. The People's Bank of China, in an effort to stimulate the economy, has aggressively lowered interest rates. As we speak, deposit rates at major Chinese banks have slid toward, and in some cases below, 1%. Factor in even a modest amount of inflation, and that money is not growing, it is dying. It is losing purchasing power every single day it sits there. The millions of savers who locked their money away years ago are now receiving notifications that their deposits are maturing, and they are being offered a renewal rate that is effectively an insult. This is the catalyst. This is the spark. The fortress of savings has become a prison of low returns. And now, the prisoners are breaking out. So if you are a Chinese investor in 2026, and you are holding a pile of cash that just matured, where do you go? You don't trust the housing market yet. That wound is still healing. You don't want to keep it in the bank for 1%. You look for something that has stood the test of time for 5,000 years. You look to gold. We are currently witnessing a gold rush in China that rivals anything seen in the 19th century. But this isn't about men with pickaxes. It's about digital flows and sovereign strategy. The price of gold has surged to record highs in early 2026, driven largely by this reallocation of Chinese capital. Retail buyers are stripping the shelves of jewelry stores in Shanghai. Physical gold bars are commanding high premiums. The Shanghai Gold Exchange is seeing volumes that dwarf historical averages. But why gold, and why now? It is not just about inflation. It is about geopolitical insurance. The Chinese public has watched the global stage. They have seen the weaponization of the US dollar. They have seen the instability in global trade routes. Gold is the only asset that is nobody else's liability. It is pure ownership. However, the retail investor is only half the story. The shadow moving the price of gold is much larger. It is the Chinese state itself. For months, reports have circulated that the People's Bank of China has resumed and accelerated its gold purchasing program. While Western central banks spent decades selling off their gold, the East has been accumulating it. China is effectively trading its trade surplus, its dollars and euros, for hard assets. This creates a floor under the gold price. When the government is buying and the people are buying, the price has only one way to go. This is a structural shift in the commodities market. We are seeing a decoupling of the gold price from real interest rates in the West. Historically, when U.S. interest rates were high, gold went down. That correlation is breaking. Why? Because the demand coming from China is so voracious that it overrides the traditional algorithms of Wall Street. And it's not just gold. We must talk about the devil's metal. We must talk about silver. While gold captures the headlines, silver is experiencing a surge that is perhaps even more explosive. In the frantic search for yield, the overflow of this $7 trillion is spilling into the silver market. Silver is unique. It is a monetary metal, yes, like gold, but it is also an industrial metal. And who is the world's factory? China. China dominates the global production of solar panels and electric vehicles. Both of these industries are voracious consumers of silver. You cannot build a high-efficiency solar panel without silver paste. You cannot build the electronics for a sophisticated EV without silver contacts. So we have a perfect storm. On one side, you have industrial demand in China hitting peak levels as they push for green energy dominance. On the other side, you have investment demand from this unlocking of household savings. Investors who feel that gold has become too expensive are turning to silver as the catch-up trade. The price of silver is reacting violently to this. We are seeing days of vertical price action. The ratio between gold and silver is compressing. Warehouses in the Shanghai Free Trade Zone are reporting tightening inventories. The physical metal is moving from west to east, draining the vaults of London and New York to satisfy the appetite of the Orient. This is no longer just a commodity trade, it is a resource security play. By hoarding silver and gold, China is insulating itself from currency shocks while simultaneously investing in the raw materials needed for the next industrial revolution. But gold and silver, for all their allure, are defensive assets. They preserve wealth. What about the investors who want to grow wealth? What about the generation that missed the real estate boom and once their turn at the table, they are turning to the stock market? For years, Chinese equities were uninvestable for many. Regulatory crackdowns on tech companies, uncertain government policies, and the property drag kept valuations historically low. But the wind has changed direction. Alongside the maturing deposits, the government has signaled a clear desire for a slow bull market. They want equity financing to replace debt financing. They want their tech companies to be world beaters. As this cash pile unlocks, we are seeing a specific targeted flow of funds into the Star 50 index. This is often called China's answer to the NASDAQ. It is home to the semiconductor manufacturers, the AI developers, and the high-tech firms that Beijing views as essential to national security. The logic of the Chinese investor is shifting. They are seeing the government support these industries. They are seeing the low valuations compared to American stocks. And they are thinking, if I put my money here, I am aligning myself with the national interest. The result is a surge in volatility and volume. The Bloomberg report highlights anecdotal evidence. Civil servants, teachers, office workers who are taking their maturing 3% certificates of deposit and dumping them into equity mutual funds. They are driven by FOMO, the fear of missing out. They watched the market rally late last year, and they are terrified of being left behind in the 1% interest rate trap. This creates a self-fulfilling prophecy. As money enters the market, prices rise. As prices rise, more maturing deposits feel the pressure to chase the returns. It is a liquidity cycle of massive proportions. Now, you might be sitting in New York or London or Sydney thinking, why does this matter to me? This is domestic Chinese money moving around inside China. It matters because capital is like water. You cannot displace $7 trillion of it without causing waves across the entire ocean. First, consider the commodity inflation. If Chinese households and the state continue to bid up the price of gold and silver, that signals a global distrust in fiat currencies. It pushes up the cost of raw materials for electronics and solar energy worldwide. Second, consider the flow of global funds. If the Chinese stock market begins to outperform the U.S. market significantly, foreign capital will begin to chase it. We are already seeing hedge funds that had abandoned China starting to look at the entry points again. They see the liquidity, they see the government support, they see the valuation gap. Third, and perhaps most importantly, is the psychological signal. This shift represents a return of risk-on sentiment in the world's second economy. For 3 years, China exported deflation to the world. Its weak demand kept prices down. If this cash pile turns into consumption and investment, China could start exporting inflation again. If Chinese factories are busy building for a booming domestic economy, the price of goods at your local Walmart or Tesco might just stop falling. However, we must remain objective. This is not a guaranteed path to prosperity. There are immense risks lurking in this transition. The Chinese government is walking a tightrope. They want a bull market, but they do not want a bubble. We have seen this movie before in 2015, when a stock market frenzy ended in a spectacular crash that wiped out the savings of millions. Beijing is aware of this. Regulators are already stepping in to cap margin financing, preventing people from borrowing money to buy stocks. They are trying to engineer a controlled explosion of this $7 trillion rather than a wildfire. Furthermore, the fundamental issues of the Chinese economy have not vanished overnight. The population is still aging rapidly. Youth unemployment remains a challenge. The real estate sector is a shadow of its former self. But the sheer weight of the money cannot be ignored. Even if only 20% of these maturing deposits enter the market, that is over $1 trillion of new buying power. That is enough to sustain a rally. That is enough to corner the silver market. That is enough to keep gold at record highs. As we look at the charts in 2026, the lines are moving up and to the right. The volume bars are growing. The dormant capital of the East is waking up. For the average person, this is a lesson in the importance of liquidity. Money goes where it is treated best. For years, it was treated best in the safety of a bank vault. Now, it is being starved there. So, it is migrating. It is migrating into the hard assets of gold and silver, seeking protection from currency debasement. It is migrating into the volatile world of technology stocks, seeking the growth that the old economy can no longer provide. We are watching a reshuffling of the deck. The $7 trillion question is not whether this shift will happen. It is already happening. The question is, how high will it push the assets that lie in its path? If you are watching the price of gold, if you are watching the silver squeeze, if you are watching the emergence of Chinese tech stocks, you are watching the aftershocks of this massive movement. The cash pile is shifting. The dragon is hoarding gold again, and the financial world will never be quite the same.